Hello everybody, it is Tuesday, February 16th, 2021. Today we have a huge housing bubble report for you. I say huge because we're going to go through a lot of information, and you know how we like to do it here. We like to touch on many different aspects of the situation. So today we're going to talk about the lending, why the housing bubble is going to continue to increase, lots of numbers, stats, charts, and details to look at today. And as always, we're going to show you all the articles. So if you want more details on any point that we bring up here, you can just go to the article that shows up on the screen. Pretty cool, right? So let's go ahead and get started. All right, let's start right here. This is redfin.com. And this shows you just how hot the housing market continues to be, even though many people back in 2020 predicted that there would be a housing market crash. Myself, right here on this channel, told you the housing market would not crash and that it would continue to inflate, and we see that happening again in 2021. Now, I wouldn't define this as hyperinflation. That's when the currency completely gets destroyed, but home prices are continually rising. And let me give you just the long and short of it. It is because endless liquidity. Endless liquidity. All right, banks can continue to lend even though they may not have the money because it is a baseless currency. You can create endless amounts of this currency, therefore you can endlessly liquefy the banks. That's the simple backbone reason behind this housing market. All right, we're going to talk about a lot more details, but I just wanted to give you that quick summary up front because that's the backbone of it all. Redfin.com U.S. housing market median sales price $334,000. That's a 13% increase year over year. Now, Redfin doesn't track every market, so this price is not going to be the same as if you look at the National Association of Realtors or other companies like Zillow that track the price, but it's going to be pretty close in the ballpark. The number of homes sold, 20% increase year over year. The mortgage rate now at 2.7% average is 1 point less than what it was last year. It was about 3.7%. All right, so we can start off here with these numbers and see the trajectory. The trajectory of the housing market is upward and onward. And yes, even though rates are at all-time lows, prices are at all-time highs, they can continue to go in the same directions. The rates can get lower and home prices can get higher, even though we are way beyond prices that we saw at the peak of the housing bubble, which ended in 2007, 2008 time period. And then I hear, no, that's impossible, JJ. Home prices can't keep going up. People can't afford the homes. People, it's not about being able to afford the homes. It's about how much you can borrow, how much the banks can continue to lend. Right? Also, you have millions of people that don't have to pay their mortgages right now. So that's housing that's not going to be put on the market, right? Who's going to sell their home if they're basically living in it for free? And they know if they move, they'll have to go out and pay rent somewhere or buy a more expensive home, which they probably can't afford because their credit's probably shot because they haven't paid their housing payment in some cases up to a year. Right? So it's this market intervention. It's really causing the housing supply to be very low. And let's go over to the Fed right here. We do see the housing supply is the lowest that it's been in about 5 years. Even with the recent uptick that we've seen here, as of December, we were at about 4.3 months of houses on the market. All right, so the month supply, even right now after this uptick, is still the lowest in over 5 years. And the assistance is going to continue. The extension for the help for homeowners because of the illness has now been pushed out to June 30th. And guess what? They're probably going to continue it after that. It's going to be never-ending continuation, expansion of the assistance programs until anyone and everyone is basically just a debt slave. And home prices continue to rise even though most people can only get into a home because of taking on a massive debt, a massive mortgage. All right, so what do we mean by endless liquidity? Well, Fannie Mae and Freddie Mac now are really stepping up their game and backing more mortgages. Let's take Fannie Mae for example. They acquired $1.4 trillion in mortgages last year in 2020, and that was up 135% from 2019. So more than double of what they took on in 2019, they took on in 2020. Pretty historical market propping. Now, how long will they continue to prop up the markets? Well, when you find out the answer to that question, that's when you know when the housing bubble is going to come to an end. When the endless liquidity gets pulled back, when these GSEs, government-sponsored entities, stop backing these mortgages, and when banks are allowed to fail, and when banks are not allowed to loan out endless amounts of money. We're talking about the Chase banks, the Bank of Americas, the Wells Fargo. They do not have to have any reserves now to make loans. That's another loosening of the lending that we've spoken about here on this channel quite frequently since that came about a year ago now. Back in March 2020 is when that started. All right, so let's again put it into perspective. Endless liquidity equals endless loans. The banks do not have to worry about foreclosures because they can just get more liquidity to fill in the gaps or fill in the voids. But foreclosures are not allowed to happen right now, so you don't have to worry about that. All right, so to sum it up, markets are completely twisted, manipulated, backwards and inside out right now. Recent article right here, this is out of mortgagenewsdaily.com. Home buyers frustrated by more competitive bidding. Here in San Diego, it's common to see 20, 25, 30 offers on a property. Why are so many people qualifying for mortgages and bidding on homes here in San Diego that are $600,000, $700,000, $800,000? Well, it's loose lending and again, endless liquidity. Let's talk about the credit scores required to get a loan right now. Recent article here, CNBC.com. What credit score is required to buy a home? Take a look at this. Conventional loan minimum credit score 620. That's not very good credit. A jumbo loan 680. That's not very good either. An FHA loan minimum credit score 500. That is very bad credit. And if you have a 580 credit score, you only need a 3.5% down payment. All right, think about that. You could be somebody that's saved up for years. Maybe you have a 50% down payment and an 820 credit score. Well, you can get outbid by someone with a 580 credit score with only 3.5% down. All right, so this is the ultimate bubble primer right here. Again, with the government coming in and backing more mortgages than ever, this is way beyond the peak of the 2000s housing bubble that we saw bust in about 2008. Not just prices, but the amount of market backing that's being done by the endless printing machine, the endless debt machine. Right? It's endless liquidity. That is the key to this whole thing. Once the liquidity is pulled away, once the lending stops, then that's when the housing bubble ends. Now, will it end in 2021? Not unless something changes. There's going to have to be a big monkey wrench thrown into the debt machine in order for that to happen. Right? Are there any lawmakers out there that are saying they're going to do that? No, it's just going to be more debt and more loosening. Let's take a look at what one of the Fed heads had to say here recently. The Fed's Bullard doesn't see an asset bubble and doubts policy will tighten soon. So there's not going to be any tightening. It's going to be lower and lower rates, more easy money, more liquidity, maybe even to the moon. Right? And it's not just the United States. Here is the Telegraph right here. Return of bumper-sized mortgages as banks loosen rules. Right? This is happening in many, many different countries. Right? It's the same system. It's all fiat money, and therefore they can keep the markets propped up basically to infinity or until something, again, throws a monkey wrench in the gears of this lending, of this debt machine. So that's the long and short of it, folks. In under 10 minutes, that pretty much sums it up. Home prices are dictated not by fundamentals, not by the earnings or salaries of the purchaser, but the level of intervention and manipulation by the money printers. It's as simple as that. When you know what the money printers are going to do, when you can forecast the debt machine, what's going to happen with it, then you can forecast exactly where the housing market's going to go. You let me know down below. Is it going to continue, or will there be a situation, an event, a monkey wrench thrown into the gears of the banking system this year. Maybe the power grid goes down, maybe a war, new regulations that are implemented, or maybe one of the string pullers, the debt masters, will hit the wrong button and the whole thing comes crashing down. I mean, you let me know. Anything's possible, but I see it going up from here unless something drastic happens. Thanks everybody for watching the support. Hope you're doing well. Stay safe, stay prepared. Bye for now. Peace.